Hi, everyone. Thank you for joining Gallati Professional Services for our first Facebook Live event. My name is Alexis Gallati, and I'm the owner of Gallati Professional Services. We're a boutique tax firm and in Knoxville, Tennessee, but I work with taxpayers all over the U.S. to help reduce their tax liability through proactive tax planning, and we do tax compliance, etc. Today, we're going to discuss the ways that small business owners get into trouble with the IRS and how they correct those mistakes. I'll take a few questions around the fourth sin, and then at the end. Please feel free to ask your questions in the comments below. And I really look forward to having an active conversation with you all. So let's get started. The first sin is very near and dear. It's actually the first thing that I ask my clients about. It's commingling of personal and business funds. Now, the IRS doesn't require that you have separate bank accounts. However, it basically shows that there's an intent to have a business and, basically making sure that you're, keeping everything separate, and the IRS won't question the business expenses as much, as long as they're legitimate. Examples of commingling funds are like depositing business checks into your personal bank account, using the same bank account for business and personal use, or even using your business credit card because you forgot your personal credit card, like at the grocery store or other venues. But by having the separate bank accounts, you're able to reduce any sort of piercing of the corporate veil. And, this can especially be troublesome for S Corps and C Corps. And when you commingle funds, the IRS will most likely deny many of those deductions. But this can be solved, at least for S Corps and C Corps, by using an accountable plan for all your employees. If you've been running your own business through your personal accounts, don't despair. What you can always do is go out right now and get a business bank account. Even if you don't have an EIN, you can still open up a separate personal account and put it in the name of the business or a DBA, and just make sure that you just keep things separate. Start depositing your business income into those into your business account. Start doing business expenses through those accounts. And just keeping everything separate up to the point where you actually now have a separate account. You can still write off all your business expenses. You'll just have to make sure to have a good record of what are personal expenses and what are business expenses. So you can just do that through Excel, or if you have another sort of bookkeeping system, like QuickBooks or Wave or et cetera. We'll touch on that in a little bit. It just makes your life a lot easier, and it looks a lot more professional to the IRS. So, please go ahead and comment. And, I want to know, are you keeping your business and personal funds separate? If yes, how are you doing it? Are you doing Excel, QuickBooks? I'm sure people would love to know, how they're being what sort of platforms people are using, and what are the most popular, and why you like them. So, sin number 2. This is kind of a short but sweet sin, I guess, if sins can be sweet. Not planning for all types of taxes and annual compliance. I've seen so many businesses go and forget the small details. They're just so hung up on federal income taxes and what they're going to pay just on their tax returns, that they completely forget about state taxes, franchise tax, excise tax, payroll tax, self-employment tax, sales and use tax, property tax on businesses, business property. I mean, it's sheer mind-boggling, and that's why we have a lot of tax advisors who will actually specialize in some areas. Some will do all of it as well. However, like here at GPS, we specialize in, federal income tax, franchise tax, excise tax, and a whole lot of other those areas. But we don't do sales tax and payroll taxes. We have other providers that we refer those out to, just because the plethora of different taxes are immense. So it's very important that if you, for example, let's say you have a retail business, or you have to think about sales tax with what you're selling, and you have to think about income tax as well. If you have employees, you have to pay those payroll taxes. And at least here in the state of Tennessee, if you have you have to pay a personal tangible property tax. So basically, if you use any personal assets in your business, then you're taxed on that. So a lot of it also too depends on your state and what your state, taxes you on. So you have to keep that in mind when having your business. The other area is annual compliance. So a lot of people will just create a C corporation, for example, and they don't understand that there's certain governances that have to be done in order to make sure that you're staying compliant, such as annual reports, meeting minutes, paying any sort of annual filing fees, to keep your business current. Like California, for example, if you're an LLC, no matter what, $800 every single year, whether you make a penny or not, California is going to get you. So, if you're not sure of what your annual requirements are, definitely consult your tax advisor or your attorney, because they'll make sure that you're on the up and up. Throughout all of these sins, documentation is king when it comes to the IRS. Basically, if you can't prove it, it doesn't exist. So make sure that you're staying compliant with all the different tax areas, and also annual compliance as well for different reports and other governances. So for those that are just joining us, we are discussing the 7 deadly sins of small business owners and what gets them basically in trouble with the IRS. So going on to sin number 3 is not paying your quarterly estimated tax payments. Now, a lot of people think that these payments are optional, and you don't have to pay them, but you don't have to pay all your taxes, but you're going to get in trouble if you don't, and you're going to get penalized. So basically, what I like to tell my clients in a Reader's Digest version is, when you're a W-2 employee, those taxes are taken out for you on with each of your paychecks. But when you're self-employed, that's not being done for you on your behalf. And IRS wants its money when you make it. So what they say is, what you need to do is pay your estimated taxes quarterly. So what basically that is if you expect to owe more than $1,000 on your tax return, you'll most likely need to pay estimated tax payments. So what that is, you pay either 100 or 110%, depending on your income, of your prior year tax liability, or 90% of your estimated current year tax liability. So for this year, we're in 2018. If you have not made any estimated tax payments, then you'll want to go and look at your 2017 tax return and see what your total tax liability was, and multiply that by 100% or 110% if your adjusted gross income is over $150,000, and divide that by 4 for the 4 quarterly payments, and then pay that amount. Or if you think that your income is going to be less in 2018 than it was in 2017, then you'll want to go and take a look at maybe calculating, estimating what your 2018 taxes are going to be. Take 90% of that, divide by 4, and then there you go. The only thing that you'll want to be careful of is making sure that you're using the correct what's it called? The correct amounts. Sorry. And what you'll want to also do is, I always recommend to my clients who have self-employment income and unearned income from investments. So, if you earn money from rentals, or, securities, Bitcoin's very popular right now. At a minimum, you should be running at least year-end tax projection to eliminate surprises and allow you to do some tax planning to help lower your tax liability before year end. So those tax projection is kind of like a mock tax return estimating your liability. I do that with all my self-employed, or at least recommend it with all my self-employed clients, and those with, like I said, significant investments. So then that way I don't like my clients being surprised, and they don't like being surprised either. It's at least that way you can plan, for your cash flow, and making sure that you have enough not only for your taxes, but any sort of retirement contributions, and, staying kosher with the IRS. So sin number 4, and I'm sure that there's going to be some of you bookkeepers out there that are going to love me for suggesting this. Having inaccurate bookkeeping or no bookkeeping at all. So biggest thing to do is don't wait until tax time to start doing your bookkeeping. You're going to save yourself a ton of headaches, and it also will allow you to look for additional deductions that you might not have known that you had. So, you'll avoid missing out on deductions and other benefits by trying to, organize your record keeping. And nowadays it's so easy. There's there's a lot of people who like to do it themselves, and then for those who don't want to spend the time doing it because they hate it, I understand. I'm not a big fan of bookkeeping either. That's why I love tax. So, if you want to go and concentrate on your business, by all means, hire someone to do it. It's going to pay you back dividends. But by going and using like QuickBooks Online or Xero, there's Wave, FreshBooks. Those are the few that I know of that are most popular. I'm sure that there's other ones out there as well, but those will easily basically connect to your bank feeds and your credit card feeds, and just bring in the transactions for you. You just go and categorize them, and you'll have a nice little report for to prepare your tax return or to give to your tax advisor at the end of the year. And believe me, your tax advisor and yourself will thank you. That's one of the things that I require of my clients, is to have some sort of bookkeeping system. It can even be as simple as Excel. If you're handy with Excel, go for it. Just have it down and have it ready for you. But the great thing about doing, like Xero and QuickBooks Online is my personal favorite. Your accountant can go and access that, and you can look at it whenever you want to through your phone, etc. And also, your accountant can do that as well. And it's especially nice for, when I have my clients use it, because I can go in there and start doing tax planning and be proactive, looking at their books and making sure that they're where we think they're going to be, or, if it's dramatically changed, then I can change their tax plan, etc. So it really does have an immense amount of benefits. And like I keep saying, your accountant will thank you. So tell me, please put in the comments, what's your favorite way to keep your business books tidy? Is it Excel, is it FreshBooks, QuickBooks? We kind of touched on that a little bit before, but I really want to know, what's your favorite? Because maybe I need to start looking at some other ones, but I'm pretty partial to QuickBooks. So let's take some questions. Let's see. We don't have anything yet, but that's okay. Let's keep going then. We're halfway through. So let's start talking about number 5. So sin number 5 is just missing out on tax deductions or not tracking them accurately. And this is where you can get in a lot of trouble with the IRS, and also miss out on things. So one of the big things I see, especially with startups, is deducting startup expenses incorrectly. So the IRS will allow you to deduct up to $10,000 of startup expenses, which consists of $5,000 for startup and then $5,000 for organizational expenses, if your total expenses don't exceed $50,000. Whatever amount is over that, basically you have to put on your depreciation schedule and amortize it. So the other thing that a lot of people don't do is they don't track their mileage accurately. This can be as simple as having a notebook in your glove box, and just every single time you do a business trip, writing down the mileage, where you're going, what you were doing, and having that available. For example, let's say for this year, you haven't started doing that yet. Go ahead and look at your calendar and try to recreate it for the year. It's still going to be good with the IRS if you didn't go and write it down right away, but go and recreate it, make sure you have it. Then that way, if the IRS ever goes and questions your mileage, you'll be safe. So another great thing is Mileage IQ, which there's tons of apps out there, but that's the one I always recommend because it's free and it does a really great job of going and basically you turn it on and it tracks where you go in your car. You just have to tell it whether it's a business trip or a personal trip, and it makes a nice little log for you, and you can email that at the end of the year to your accountant or have it available for yourself for tax prep. Easy peasy. The other thing with the IRS is not keeping receipts. I can't emphasize this enough. If the receipt doesn't exist, the deduction doesn't exist. And credit card statements don't always fly with the IRS. So it's important to actually keep the little slip of paper. And you'll want to go and, if it's not clear what it's for, just make a little note on the receipt and go and put that in your file. And you don't have to keep a stack of receipts. You can even do digital, go and scan them and get them into Google Docs or not Google Docs, Google Drive, or if you've used QuickBooks, or I think Xero has it too, but basically in QuickBooks, you're able to just attach that receipt to the transaction that's in there. And so you have it right away. It's really great. But the IRS will be allowed to disallow anything that doesn't have a receipt. So keep it. Another way is to try to find legitimate ways to write off personal expenses for your business. So, for example, like Section 105 plans, which are for medical reimbursement plans. And so a lot of times people will be able to, not a lot of times, what you can do is write off medical expenses, not just your healthcare expenses or healthcare premiums, but also any healthcare expenses, co-pays, contacts, those sort of out-of-pocket medical expenses. When you have that in place, it allows you to go and write them off. So, that's what I do with my clients is I look at areas of personal expenses that might be legitimate deductions for their business that they just might not be aware of. So just keep that in mind. You can look at the code or talk to your tax advisor about it and, get those extra deductions. The next biggest thing is to just make sure you're not exaggerating your deductions either, because the IRS will just slam you for it. So, my personal favorite to talk about is clothing and makeup. People assume, oh, I bought this suit, I can go and write it off. No, it doesn't work like that. You can only write off things like clothing that you can't wear outside of your work. So like hazmat suits is a good example. When it comes to like makeup, a good example of being able to write that off is if you're, I had a client who was a professional opera singer. And so she had to have special stage makeup in order to, for people to see it. And it wouldn't be something she would wear out in a normal day. So that's something that would be deductible. So just, you can get creative with your deductions, but they have to be legitimate deductions, and don't over exaggerate or the IRS will nail you. So another cardinal sin that I see all the time is employers classifying their employees as independent contractors. The consequence of this is astronomical. Depending on how long you've been doing it, basically you need to pay back, the taxes, payroll taxes, et cetera, unemployment taxes, and there'll be penalties and interest on top of that. So, just real fast, what makes an employee? You have to be able to control their behavior. So the degree of the employer exercises control over the worker's time and tools, financial control, whether you're paid on salary or by the hour versus, like a flat fee job would be more appropriate for an independent contractor. And then the types of relationships, if the work is being done directly related to the company's core work, then the worker is probably an employee. But if you have someone who is providing a service that's periphery of the business, they could be designated as an independent contractor. Talk to your tax advisor about it, because it's an area where you just don't want to get nabbed by the IRS, because payroll tax penalties and et cetera it can build up really fast and snowball. So for those of you just joining us, I want to say again, we're discussing the 7 deadly sins of small business owners that get them in trouble with the IRS. So the last big one, last deadly sin, is choosing the wrong entity. And, a lot of people just think, oh, I'm a business now, I'm going to be an LLC. Well, why? Because your friend down the street has done it, well, that might not be a good decision for you. So the major entities are, sole proprietorship, single member LLC, partnerships, S corps, and C corps. I'm not going to get into great detail about what makes one better than the other, or advantages, disadvantages, et cetera. I could do a whole show on just that. I could probably do like 10 shows on it. But basically, you want to make sure that the entity you're in is, providing you the right liability protection, and then also, this correct tax savings. And I've even had clients who set up multiple entities in order to take advantage of different tax savings. I see most people opening up LLCs and C corps. LLCs are great for asset protection, but they won't save you really any additional tax unless you elected to be an S corp or a C corp. And then with C corps, they're generally subject to double taxation, once at the corporate level and once at the individual level. So, and that might still work out, especially now with tax reform. C corps are a lot, their tax rate's now down to 21%. Which is great. So, if you're only in the 15% tax, 15% tax on dividends, that might be lower than your overall tax rate. So, it's just something to think about. And, sometimes it's best to stay with a sole proprietorship until your business is viable, and because it's, and then you have enough profit to make sure, making sure that this change is worthwhile. Sole proprietorships are obviously the easiest thing to set up. You just start working. So, it doesn't cost anything extra, maybe doing a DBA. And, the right entity will sometimes also depend on your state. So for example, like in Tennessee, we have the Hall tax, and that's at 3% for 2018. And that's on interest and dividends. And so, a lot of people think, oh, well, you're in Tennessee, you don't have any state income tax. Well, that's true, but we do have the Hall tax on interest and dividends. And, for S corp owners, any distributions above their reasonable compensation is subject to that 3% Hall tax. So you have to take that into consideration. Depending on how much you make, 3% can be, a good amount. So, there's also a handful of states such as Texas, Illinois, Tennessee, Missouri that also allow series LLCs, which are great for real estate investors. They allow LLCs, they allow you to set up multiple LLCs, but only pay one filing fee. That's a real, generalization. But, it can be a really great tool to use if it's right for your situation. And then also too, there's some entities which allow you to deduct certain expenses that others don't. So, for example, C corps, and you can enjoy a wide range of fringe benefits for employees, owners that aren't allowed for S corp owners. S corp owners. Like such as life insurance and disability insurance deductions. So let's summarize what we just talked about. We talked about don't commingle your funds between business and personal. Plan for all types of taxes and annual compliance. Pay your quarterly estimated tax payments. Get your bookkeeping order right now. Like, that's the first thing you should do off of this. If you don't have your bookkeeping in order, go do it. Don't miss out on deductions by not planning properly. Classify your workers properly as employees or independent contractors, and choose the best entity for your goals and to minimize tax. So with all these mistakes, the best things you can do right now is start educating yourself through reputable online sources, like my blog, shameless plug, of course. Talking to your tax advisor, making sure you have a reputable and competent tax advisor who will work proactively with you to, build your wealth and grow your business. A lot of people will not want to hire someone because, of the additional cost. However, don't step over $1 to save a penny. So it's, these experts will save you money in the end. So let's take some questions. Let's see. Great. Okay. Well, there's no questions. We have about 3 more minutes left. If anybody wants to chime in with something, and, I'm happy to answer anything. If you don't have any questions about right now, but you think of some, please go ahead and don't hesitate to contact me via the Facebook Messenger on my Facebook page, email, website. I put my email address and my phone number as well in the description of this video. And, if you're looking for a tax advisor who will work proactively to grow your business and your wealth, I'm happy to go and speak with you to see if we're a good fit. So since there's nobody that has any questions at this moment, I'm going to say thank you so much for joining me. I hope that you learned something and can go and implement some of these ideas into your business. Or if you're just starting your business, get started on the right foot. Our next Facebook Live will be July 19th at 5 p.m. Eastern Time, and we'll discuss my top 3 favorite tax reform changes to save you money. So thanks, everyone, and enjoy your weekend.